Has Jay Powell finally started up or restarted the Federal Reserve's money printer? That seems to be the message the stock market is taking away. But there's a lot of things in what Jay Powell said at Jackson Hole that people are missing. What he actually said was, after telling everyone for basically the last 6 months, or really going back all year, to expect tariff inflation, he's in one sense throwing in the towel on it, saying that very clearly the risks have changed. So reading between Jay Powell's lines, what he's really saying is we haven't seen the tariff inflation, and maybe if we do see it, it will only be a one-time thing, though he did avoid the use of the word transitory. However, what he really did say was, as we've been talking about here at Eurodollar University, is that the U.S. economy is at the very least at risk of transitioning on the Beveridge curve, going from the vertical part to the flat part where nobody wants to go. And having avoided seeing that transition for all of this time, Mr. Powell at Jackson Hole here in August of 2025 said, I now see the risks. And it goes beyond that. The market is seeing it too. While the stock market is soaring, thinking that rate cuts are going to be a help to the economy and therefore the marketplace, or that somehow lower interest rates are extra money and liquidity in the economy, the bond market and especially forward rate markets are seeing not just that Powell's going to cut, but what the implications of that moving into the longer run. For example, the term SOFR futures curve has deepened its inversion and extended it out into 2027. The bottom of that inversion, which had been around the middle of 2026 and then creeping toward the end of 2026, is now moving into 2027. What the market is basically saying is that now Powell is admitting the danger of the economy transitioning to flat part of the Beveridge curve. Things could get really serious. I mean, even more serious than the market was pricing before, that ends up extending rate cutting and lower interest rates further into the future and farther down. Where have we heard that one before? That's what the swap market has been telling us. And what happened at Jackson Hole was Powell, in this long and winding process, put another marker down on the road to that same future. Now, Steve, Mr. Van Metre, I know you saw Powell's performance too. What was your take on his speech? Was it a surprise that he came out so seemingly dovish? Was this something we should have been expected? Were you expecting more out of Powell or even less out of Powell?
Jeff, I thought he was going to kind of stand back and say, look, we're data dependent. And yes, the data wasn't right, but look, the tax cuts went through and we know businesses have been really worried about taxes. We've seen that in all the surveys. I thought he was going to say, well, the trade war, is wrapping up and perhaps this was a reason we haven't seen hiring. So I kind of really, thought that he was going to kind of hold his ground here. So I was a little bit surprised that he started to kind of bring up the labor market. Now, of course, this is a canary in the coal mine that we've been flagging. We know that the Fed fixates on inflation until the economy starts to turn down. And then when the labor market goes, Jeff, you and I know, people on unemployment don't have money to spend. And inflation becomes a transitory issue. So we're starting to see Powell wake up to the reality here is that perhaps the labor market has shifted. But there was something real key here. And for quite a while, Jeff, we've been hearing the Fed, not just Powell, but all the speakers say that, they're in restrictive territory. And I think this is really important to understand is they wanted to say that so they could back off a little bit because there's this belief that there's some magical neutral rate where you don't get inflation, but you don't get an economic unwind, that we need to find the balance. So they've been restrictive so they could cut a little bit. And I think today's messaging from Powell was all about the reaction of the equity markets. I think he got the exact reaction he did from stocks. Now, as you said, the bond markets say, look, no, this is not a liquidity pump. This is not going to juice the economy. This is the leading indicator that we've all been saying is the economy is falling apart. But that's not what he was concerned about. He wanted stocks to go up, and I think he got it.
We got like a perception change here at the Fed, and I think Powell is going along with it. I mean, remember, Steve, back on August 1st, the payroll report, you and I, we did a live stream on the payroll numbers and we said, watch for these things to happen. And they have happened. So first we got the big downdraft in short-term interest rates, especially the 2-year, but also bill rates. Bill rates have been going lower as well. And then we said, okay, watch the short end of the yield curve. Will they give those rates back? Because you're going to get back and forth of information. And really in August, the only piece of information that kind of looked like tariff inflation was the PPI. And the short-term rates did back up a little bit in response to the PPI, but overall, short-term rates have been hanging in at the lower end of the range. And then we said, what was the other thing we said? We said, watch for the Fed speakers. They're going to start shifting too. And the big one was going to be Jay Powell. So immediately after the payroll report, we had Waller and Bowman who were already dissented at the previous meeting. Then you had, I forget who, Mary Daly and Bostic, and now the beleaguered Lisa Cook, who said, okay, maybe we start to leaning toward employment risk. And now, to me, I think what Powell did by coming out so really honest here and not just hammering home his tariff inflation theme that he's been hammering home all this time. He basically said, yeah, I think we could have an employment problem here. That's the latest and maybe the greatest one in this progression from the payroll report. And he, of course, he mentioned the payroll report a couple of different times. So you can tell that really shook everything up at the FOMC. But my point is that everything has been falling in place. And what the market is saying is that as the Fed restarts in September, that is another indication that the entire economy, the U.S. economy, the labor market are all indeed moving in that direction and have done so. And this is the important part. They have done so decisively. Even the previous, I'm only worried about tariff inflation, hawk Powell has shifted his tune. So that's the reason why we pay attention to these Fed speakers to begin with, because even if they see employment as the biggest risk, it has to be the biggest risk. As we continue to talk about all of the downside possibilities that continue to pile up here in 2025, it makes perfect sense, therefore, to own gold. But gold, as a great store of value and error hedge, is still missing something. It's missing something big, and it's what we talk about all the time here at Eurodollar University. What it's missing is the ability to use it, to go back to where it was a long time ago, as both a store of value as well as a medium of exchange. And that's where Glint comes in. They're actually working to solve this major problem, to make gold useful again. Not just a great error hedge, but something that you can actually spend. This is allocated physical gold stored in a secure Brinks vault. It's fully insured. It's fully yours. With Glint, you can buy gold, you can save it, and you can spend it almost anywhere MasterCard is accepted. At the grocery store, for airline tickets, at the steakhouse, online shopping, it doesn't matter. You swipe and a fraction of your gold is sold in real time. You still own the gold until the moment it's used. No middleman, no IOUs, no derivatives. This is gold as money again. So go to your favorite app store and download the Glint Pay app and use referral code SNIDER so they know that I sent you, and see how they're rebuilding money and rebuilding trust in money 1 gram at a time. Again, that's Glint Pay in the app store. Use referral code SNIDER. And now let's get back to our video.
Yeah, Jeff, and I think that's why the upcoming non-farm payroll report, barring its questionable accuracy to begin with, but there's going to be so much focus on this report because it's really going to set the stage for, is there going to be a September cut? Because you can look at Powell, he did lean, he was dovish, as you said in the beginning of the show, but he doesn't really want to be dovish here because he knows if the economy continues to go down and he cut too much, he can't use the magic of monetary policy, say, look, I'm slashing rates and everything's going to be great. I think this is a problem we're going to see in various central banks around the world that have cut rates too much that have no impact. But one thing he can go back and say is, look, the unemployment rate was rising, and then I cut 50 basis points, and look, it's largely plateaued. So it kind of the magic of monetary policy worked here. But I think he's afraid something is going to cause this thing to spiral out of control. We've seen continued claims. They're hovering near 2 million. Now that number in my book, Jeff, that's the line of the stand. You get over 2 million, I think we're going to see this thing get out of control. But then again, you can turn back to S&P Global's preliminary PMIs and you can say, well, they both turned up, suggesting that perhaps maybe things aren't that bad. So I think that pay report is going to be critical here. I think it's going to really kind of drive the question of, I think right now Powell's talking 25 basis points. I know you're on the book for 50. My opinion will vastly change after we get the next payroll report.
Yeah, I think I want to flag one of the quotes, or I actually want to talk about a couple of his quotes from Jackson Hole, because I think these are the parts that might surprise some people. We've been talking about the Beveridge curve, and the Beveridge curve, it's not really a curve. It's basically a graphical tool that shows people an illustration of how the economy is progressing through either rising employment or rising unemployment. And it tries to get at the point at which rising employment, or actually decelerating employment, becomes rising unemployment. That's what the Beveridge curve is about. And when you get to that spot on the curve where it starts to go flat, which means unemployment really starts rising, it tends to rise pretty quickly. So we scrutinize the Beveridge curve as a way to say, are we in that danger zone? that transition period where everything looks fine, but just is slowing down to suddenly, holy crap, people are losing their jobs. And what Powell said at Jackson Hole was, I see that danger too. Here's the quote from Powell in his speech. This unusual situation suggests that downside risks to employment are rising. Of course, that's no surprise there. But if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. And that's the reference to the Beveridge curve. And then he added to that, that especially after the payroll report for the month of July, that which came out on August 1st, they're now really taking that more seriously than they were transitory tariff inflation. In fact, he actually mentioned that as well. He said, well, I was worried about tariff inflation. Reasonably, all the evidence that we have and our reasonable conclusion is if we do still get some spike in prices due to tariffs, he didn't use the word transitory, but that was the message, that it's likely to be temporary, simply because as the Federal Reserve's, the FOMC minutes for the last meeting showed, and it mentioned that demand is too weak to absorb higher costs. Therefore, higher costs actually contribute, get this, Steve, higher costs actually contribute to more disinflation and economic weakness down the road. So Powell wasn't just sounding dovish. He is starting to make sense too. And that's one point that I really want to emphasize here, is that we know things are going bad and the feces are getting closer to the fan blades when central bankers or economists, same thing, start to make a whole lot of sense when it comes to economics.
Yeah, Jeff, and I think this all comes back to the U.S. consumer because, for several months, what do we see? An acceleration in retail sales. So it kind of gave you the impression, if you're, say, a political lead or a Fed speaker, that, hey, maybe the consumer's okay here. Maybe they can afford higher prices. And we said, no, they can't. They're just front running the tariffs. Watch out, because this thing's going to roll over. And it did. And then what did we hear from Home Depot this week? They said, look, we can't really push across price pressures, but we've put together effectively an internal board to figure out how we can sneak price pressure increases across to our consumers because, hey, we really need to raise prices and they don't like it. Walmart came out, had a sales miss, which is kind of a profit miss. It was very unusual, but even they suggested, which is great. They said, hey, we're doing great because people of all income levels are shopping at Walmart. And my thought was, rich people don't want to shop at Walmart. They're shopping there because the delinquency rate for higher income Americans and credit cards and cars is rising. So there's real stresses going on here. And I think what Powell's starting to figure out is, you're right, consumers can't afford higher prices. And in fact, we're even seeing some businesses start to come out and admit to the fact that they're like, look, I'm a seasonal second half of the year business, and to pay the tariffs, I had to go borrow a bunch of money. And if I don't sell through this inventory, I got problems, and I've already started cutting employees. And I think this is what the reality of the situation is. If the economy doesn't push through the second half, businesses are going to lay off. Powell knows it. But whether it's 0.25% or 0.5% cut in September, it doesn't matter. It's not going to make any difference.
No, but a lot of people do want to focus on that because, I mean, it sounds like it's an important thing. And maybe it is in a way because, again, we read the Federal Reserve as sort of like, if they see it, then it must be serious. And so just like last summer when things started to get serious, if the Fed cuts by 15 September, things are going in the wrong direction. So I think it does matter in that respect. But you're right, Steve. It's not going to steady the economy. In fact, we did 100, the Fed did 100 basis points in rate cuts last year. Here we are in the next year forward, the next summer, and we're still talking about all the same things. In fact, we're talking about them with them having gone worse. That was one last thing that Powell did mention, is that he definitely was clear about where he's laying blame for all of this. He basically came out and said, look, we thought the economy was weakening last year. We did 100 basis points of rate cuts, and that seemed to have worked. We stabilized the economy. Everything seemed to be moving on, at least in the right direction. Then a whole bunch of policies came out from this new administration on it wasn't just tariffs. It was all sorts of tax policy, immigration, as well as trade wars. And that's the reason why we now have to deal with an employment problem. So that's another thing that Mr. Van Metre has been saying for quite some time. The Federal Reserve, as they went screaming and kicking toward the next series of rate cuts, they had to have a scapegoat to say, well, we got to preserve the legacy and the legend of rate cuts. Therefore, we have to have some other thing come along that must explain why the last series of rate cuts didn't leave us in good shape so that we can avoid the next series of rate cuts. Now that we're heading toward the next series of rate cuts, we have to have an excuse. And Powell laid that out at Jackson Hole and then some.
Yeah, Jeff, because the consensus view right now is all the economy does need is a couple rate cuts. I mean, we've been hearing from President Trump for quite a while that, hey, look, I'm doing all these things, but you're holding the economy back. As I said earlier, small businesses said we need this tax cut. Well, okay, you got it. The trade war needs to come to an end. Well, it's kind of appears that that's happening. So what do you do when everything else is allegedly done and the economy is set to surge, but it's not? You find someone to blame it on. So you blame it on the Fed and say, look, other central banks are cutting rates. You should be cutting rates. But it comes back to the problem that you said earlier in the show. The bond market saying, no, this is not a good thing. The economy is going the wrong direction. And yes, there is problems here. Growth and inflation are coming down. But you're going to hear a lot of people today, Jeff, say, but the S&P probably closed at a new all-time high. Tech stocks were up, small caps were up, oil was up. This is a bullish indicator that the market's pricing in money printing and demand. All that the U.S. consumer really needed was a little bit of rate cut. But if you ask the average consumer right now, a rate cut isn't going to fix the problem that they go to work and there's not that much work. It's not going to fix the problem for the nearly 2 million people that are on unemployment and can't find another job. That is the real issue here, is a rate cut isn't really going to change anything. And again, that's exactly what you're saying. This is why Powell needed to come out and start blaming other people, because he knows I'm probably cutting in September. It is not going to work.
Yeah, I think that's, it wasn't just consumer. It's not just consumers who say that lower interest rates aren't going to help. I mean, that's what the message I took away from Home Depot's CEO was, that he said, look, we're in the home improvement business. Our business is tied to housing, and our situation is not going to be fixed by a couple of interest rate cuts from the Federal Reserve or just lower mortgage rates in general. What he's basically said was economic uncertainty, right? That's the term that everybody uses. But as I keep pointing out, the economy is becoming more certain, not less certain. And so what he's really saying is our customers have no money. It's not going to matter if their interest rates go down. Interest rates are going to go down because they're reflecting the economic weakness. Our customers have no money. Target said the same thing. We got tons of inventory that's piling up because we can't sell it. Every time that we try to raise prices, we end up losing demand. People stop coming to the stores. Foot traffic, your favorite measure, Steve. They keep saying we lose foot traffic every time we raise prices. Tariffs were never going to be inflationary because the economic situation was bad to begin with. And everything that we have this year says it's getting worse. And now that includes Jay Powell, who wants to be hawkish, who wants to talk about a tariff inflation, who wants a parade at the end of this for having said we slew the inflation monster. So he wants an inflation monster to slay. He can't even say that. Now, just for the second year in a row, he has to admit, oh, by the way, the employment situation is not what we thought it was. Our understanding of the economy, maybe we really don't know what we're doing here.
Jeff, of course they don't know what they're doing. That's the brilliant thing. Adding on to this, you did a show the other day on McDonald's. I remember when they came out kind of post-pandemic with their $5 meal deal, and they said, hey, look, this is really temporary. We're just going to put this out there because people are struggling a little bit. I remember we talked about it at the time. I said, this is not temporary. This is going to be permanent. You wait and see. And now what? They're cutting the price of the value meal because their gimmicks are working to get people in, but they're saying, look, low-income people can't afford a $15 value meal. Well, you know what? I don't blame them, Jeff. I inadvertently went to Jersey Mike's the other night. I wasn't intending to, but I was out, and my girlfriend wasn't home. So I'm like, I would get a sandwich. I was shocked at a sandwich, and I didn't know this was $12. I'm like, how do people afford this? And that's the reality is, people can't afford it. So you think about it, would a 25 basis point or 50 basis point cut fix the problem at McDonald's or Jersey Mike's or Target or Walmart? No, it's not going to fix any of those problems. And the issue, again, we come back to the fact the Fed doesn't know what they're doing, but they don't have a clear scapegoat because everybody's saying right now is, look, Fed, the problem is yours. And can't you see the stock market is validating this? But the problem is we're going to see more companies get squeezed at the margin. I know investors think this is super bullish, but wait till they find out in the coming quarters just how much of these tariffs these companies had to absorb. And when you put on top of that falling sales, man, the bullish case for stocks is going to be hard to understand.
Yeah, it always comes back to jobs and incomes. That's what everything comes back. That's the reason why nobody can afford higher prices to begin with. I mean, we've talked about this however many times. If incomes were growing at or above the consumer price rate change, We wouldn't be standing here. We wouldn't be talking about this. I mean, prices would go up and everybody would complain. They wouldn't be happy, but they would be paying for them. And then when something comes along like a tariff shock, incomes would absorb it. Companies would pass those along to consumers. It would still be a one-time thing, but we wouldn't see the violent reactions that we're getting all across the system. And we are getting those. That's what the Fed is basically saying. They're saying, look, we thought that tariffs are going to raise inflation risks. They haven't. And the reason they haven't is because what we're seeing over here in the jobs numbers. They're basically admitting that, we thought we were going to have we thought we had a steady employment situation, therefore it was going to lead to an inflation problem. What we found out is that we have a less than steady employment situation that removes the inflation problem. And in that situation, there's only one thing for the Fed to do because it only has one tool, and it's not a money printer. It's a psychological manipulation through lower federal funds rate, which the market has been saying you should have expected for years, and that we are still early in this process, that rates are still going to go down because, as we all know, the Pringles can, once they start popping on rate cuts, they will not stop. And so here is Jay Powell and Jackson Hole saying, give me some more Pringles because we need to start all over again.